Welcome to the stock play of the day. Today's stock is XLV. This is the S&P Healthcare Spider ETF. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey. Well, we had a couple of good Mondays. This Monday doesn't seem to be quite so good. What are you seeing going on in the markets this week?
Yeah, I got more red this Monday than we have seen in the past. But you know what? We're coming off of 2 positive weeks in the market, something we haven't seen since February 14th. I mean, look at that chart right there. It's been hard for us to see consecutive weeks of upside. So we're taking a little off the table this morning, and that's really being driven by what we're seeing in oil prices, down 40%, Brian. Can you believe it? The price of, can you believe it? When do you remember seeing oil below $12 a barrel, Brian?
I don't think I was alive when that happened, and I'm a kind of an old guy, and yeah, I don't think it's ever been in my lifetime. Not to mention, I heard the other day somebody say that a beer in Canada costs more now than a barrel of oil. Just crazy.
Well, I do have a stat for you. The last time the oil was under $12 was in 1998. So you were alive, just a little bit younger than you are today.
All right.
But yeah, so that's putting pressure on the market, and it's really coming down to, we've had this supply and demand issue in the oil market. We have supply building up. The oil reserves here in the U.S. are almost at capacity. There's a lot of oil on ships on the water coming to the U.S. There's not room for that oil or demand for that in refineries. So the demand side is also coming under pressure as economies around the globe were shut down because of the coronavirus pandemic. So what you're seeing is that the May contract for oil expires tomorrow. So there's a lot of pressure on the price of oil coming down because of that, both the supply and demand issue there. So that's what's impacting, and then that's just reverberating through the market. It's another reminder really to investors that demand and the economy has slowed very sharply over the course of the last month and a half or so. So that's putting pressure on. Also, on the deck for the week is earnings. We have about 23% of the S&P 500 reported earnings week. IBM reports after the close. So there's a lot to watch here in the marketplace. Again, it's Monday, just beginning of the week. We'll see how things turn out as the week unfolds.
All right, and then the VIX index, right? We saw
that's right. The VIX is above 40 again, Brian. What do you make of it?
Well, for the first time, the VIX index is actually above 40 for the whole week. But my big number in the VIX, and I've mentioned it a lot of times on the stock play of the day, is that 50 level. So I do think that 40 is the new 20 in this market environment. And as long as we're sticking around that level, I feel fairly comfortable. And I say that as I cringe. But in general, when the VIX is around this level, a little bit of the fear has came out of the marketplace. We don't see these insane volatilities. I'm seeing it across the board on all the stocks. Almost every stock that we've talked about on the stock play of the day, the implied volatilities have came down precipitously. And that's going to be the case in what we're looking at today too in the XLF. But with that being said, we have a couple of listener questions from last week. And I want to remind everybody that we will address your questions in this at-home stock play of the day. Just type them into the chat box in the right rail and we'll address them next week. And we did have a good question, and I'll pass it back to you, Lindsey, about the...
Yeah, I have that question right here. It was from Brian W. Thanks for the question. It's about small caps. Is it time to get bullish with all the stimulus from the government coming through? And I think both of us have an opinion on this, so I'll just start. And I would say, I don't think it's time right now. The small cap stocks, these are companies that are already going into this crisis were saddled with significant amount of debt. In fact, I think they have at least two times more debt on a debt to EBITDA basis now than they did going into and out of the financial crisis, the great financial crisis of 08, 09. So they're in a tough position right now. And, you know, even if the economy were to open up tomorrow or the end of the month or, you know, mid-month in May, it's really not so much about the government opening up the economy. It's more about when our consumers can feel comfortable going back and really going out into the economy and consuming again. Brian, what are your thoughts?
Well, I have I have a lot of friends that own some small businesses, and
Mhm.
they just don't really have the power to even do the cleaning. I have a few friends that I talked to over the weekend, obviously social distancing. But with that being said, I have a few friends that had just discussed that they're just shutting down their warehouses. They're small business owners, and they just don't want to take the risk to their employees. They have a few employees, but they're really counting on the PPP program to try to just keep them afloat until they feel comfortable opening up their warehouses and doing their business again. So overall, that stimulus is just keeping them going. It's not accelerating their sales or accelerating their business, is what I'm hearing from people that I know that are small business owners overall.
Yeah, and the good news there too is that the government is, you know, allegedly getting close to a deal to um, add more money to the PPP program. So, knock on wood, hopefully that does happen soon, and they can expedite getting more of these loans out. But
Right.
TBD.
But with that said, I'm kind of impressed with what happened with the Russell not that long ago. They let us lower, but then last week we had a couple of weeks where we were up more in the Russell than in the other indexes because we had a couple of positive weeks next week. So I guess there is a point where there is a time where you might want to start investing in small businesses, but I don't think the worst is over just yet.
I think we're in agreement, Brian. But with that, why don't we move to the stock play of the day? What do you think?
Yeah, let's do it. I have a chart here now of the XLV. And what are some of your thoughts on the healthcare sector?
I think you're showing the options chain right there, but yeah, healthcare has had a miraculous rebound. Brian, you got the options chain up, so can you show the chart?
Yep, there it is.
There you go. So look, you see this beautiful rebound, right? Since the bottom for them, which was, I think that's March 21st. It's up 34%. In, you know, what amounts to be about a month. So a spectacular run. But if you look at valuation, and you know me, Brian, I'm always talking about valuation, right? So on a forward PE basis, the healthcare sector is trading at 16.2 times, which is about in line with its 6-year average. And that's one of very few sectors within the S&P 500 that's trading in line. Most sectors are trading right now, given the massive run that we've had in the market over the last several weeks, are trading again at a premium. You've got the S&P 500 trading at over 20 times on a forward basis, which is a little bit crazy. Very sharply while the market was moving higher. So eventually that's going to have to shake itself out. But getting back to healthcare here, you know, there's been some good news on the healthcare front. We've heard from Gilead and some others. Gilead on Friday came out and, you know, there's news that their antiviral treatment for coronavirus was seeing really good early results. So that kind of, I think, boosted the stock on Friday. Also got investors excited about the potential to reopen the economy, because if you have a treatment, you know, it takes longer to create a vaccine, but if you have a treatment for coronavirus, that means that people are going to feel a lot more comfortable about going out and the economy restarting, like I just talked about. So if they know there's a treatment that if they get it, they can get healed from very quickly. So that was a positive. And you've seen some of these biotech and pharmaceutical companies pop more recently on that news, and they seem like they could be getting a little bit stretched, because think about it, Brian, they're probably not going to make a ton of money on those treatments. Hopefully they get their costs back, but given the dire situation, it might be they might have to distribute it at a little bit lower price versus cost. I'm not sure. I'm not a healthcare expert, but that's what some analysts are talking about. But anyway, the healthcare sector, again, overall, it's a defensive sector. The valuations look good, right? Like I just said. And this is a sector that always does well in uncertain times or when the market's going down. I always say look back at 2018 for one of the most recent comparisons. If you look at 2018, you'll see that the healthcare sector was the only sector within the S&P 500 that actually ended the last 6 months of the year positive from June until December 30th, while the rest of the market went into a near bear market territory at the end of 2018. So I just really like the defensive nature of this sector. I really like the fact that more likely than not, our government is going to be more focused on the healthcare situation in our country, given this pandemic that we just went through, and clearly we weren't very prepared for it. So I think this is going to be a sector that benefits when we come out on the other side of it, and going into, especially you think about election years are usually not the best year to invest in healthcare, but it has front and center for governments around the world to be focused on being prepared for these types of situations. Many commentators were calling this war going into the pandemic. Anyway, I think I'm getting a little bit long-winded here, Brian. So I'll pass it off to you to see what you think the options trade can be here. I think fundamentally, even though the sector has run up, valuations still look good, and I see promise the future.
Right. And so if I'm looking at the chart to start before I jump into that chain, which I was a little premature with my chain earlier, but momentum. And I think that that's the key that I picked up from what you were saying, and that here's the 20-day moving average, here's the 200-day, here's the 50-day, simple moving averages. And we're just seeing some momentum in the stock. In other words, we're getting above those averages. Now, you don't want to get too high above them, but just the fact that we are above those averages, that's most sectors are not, if you're looking at their ETFs. And if I just even point down to the RSI down here, it's still not showing that we're overbought yet, and that the RSI is below 80, which is kind of the magic number in the RSI. Once you get over that, that's just one other indicator to look at. So the chart doesn't look bad. We got the V-shaped recovery that happened in the stock, the big downturn, the big whiplash back up. So with that said, let's go and look at some option trades. One of the things that I noticed by looking at a volatility chart today, as I mentioned earlier, the VIX is now above 40, but it's still staying within, I'm going to say between 35 and 45, it's staying within that range. And I mentioned that a lot of the sectors, the implied volatility has came down. So in the XLV, in that stock, looking on a 30-day basis, that was up around 70, 80% implied volatility when we saw the bottom of the V as far as the stock price in the market is concerned. Now we've seen that come back down, and now we're around the 30% level. Much more comfortable levels. Once again, if you look at the historical going all the way back 3 or 4 years ago, in general, the implied volatility is usually about 15 to 20%. So we still got a little bit of a ways to go. But I'm feeling a little bit more comfortable about buying options just because we've had a decent downturn in implied volatility in the general market, and very much so in this underlying stock. So the paper trade for this week is going to be a long call. We're just going to go out in time. We're going to buy something that's going to act as a surrogate for the stock. And by going a little bit deeper in the money, we're going to get a little bit more delta, which means that when we buy that option contract, that option will act more and more like the actual underlying stock does. So I get a lot of good stock representation. And the time period, we're going to go out into the summer months. We're going to go out till June. We're going to go basically the third week in June, which is the normal expiration date for option contracts. Normal, I say. Nowadays, I don't know if there is any normal. There's so many different expirations that are out there. But in general, this is the monthly expiration. That's what we're going to be looking to be buying. And we're going to go a little deeper in the money, and we're going to limit our risk. And so if I look at the option chain, which I think this is the option chain, there we go. Got the right.
May I ask a question, Brian? Why a month? Why is the month the timeline, the normal expiration, or the best place to be when you're doing a call?
Yes, definitely. Well, the monthly option contracts are the standard contracts. So there's not really a good term for it, but back in the day, they used to only trade monthly contracts, which means that that option expires on the third Friday of the month. That was the magic date. Nowadays, with the advent of computers, honestly, now they offer many more expirations, and they offer things that are called weeklies, and they also have quarterlies. But because of the data pull that it used to be back in the day, to quote all these option contracts, they only had one monthly contract, and that day, that magic day, was that third Friday of the month. So with
Got
that
it.
said, that's part of the rotation, and that gets the most play because, first of all, it's part of the rotation. Those contracts get opened up more often. In other words, the part of the normal cycle, and a lot of people will run to them, and you usually see more volume, more open interest, which means better markets, just overall.
Yeah, makes a lot of sense. Thank you.
That's a great question. Thank you. All right, so I'm going to go out to the June expiration, and we have the stock right now at 100.54. Let's see where we're down a quarter on the day. So the ETF is doing much better than the actual market is overall. And as I mentioned, I'm going to focus on Delta here. We're going to go a little deep into money, and I picked this strike because it's basically 10% of the underlying stock. The stock is trading at 100. The ask price right now is 10.05. I would probably try to work that a little bit. But if I pay $10 for this option contract, I have 10% risk overall, and I'm going to limit my risk. We're going to actually use options what they're first intended for. Instead of buying the stock outright and having risk all the way from 100 all the way down to 0, we're going to actually just manage our risk, and our total risk will now be what we paid for that option contract. And if I focus on Delta over here, we see the Delta's at 74. That means that if this underlying goes up $1, this option contract should go up 74 cents. Another way to say that is we should make 74% of the stock price movement. So if I spend $100 and buy 100 shares, it goes up when I make $100. Here I pay $1,000 on this, or $10 times 100 shares, and it goes up when I make $75. So I'm still using options to limit risk. I don't mind buying the implied volatility. If I show you right over here next to our Delta, on our I should actually point out that we're on the call side of the Ally Invest option chains, is at 33%. Like I said, not that long ago, actually a couple of weeks ago, the implied volatility was all the way up around 80 in this underlying. So this is going to be our paper trade for the week. It's just a normal long call. And right now the midpoint is at 990. If I could fill it there, that's fine. The ask is at 10. Fairly decent market, and that has a lot to do with what I mentioned with you, Lindsey, that if we're going to go a little bit deeper in the money, get a little bit nervous about the width of the market between the bid-ask spread. That's one of the issues with buying deeper in the money call options. But because we're staying in that normal monthly June contract, we usually get a little bit tighter markets on it. We have, let me see, 60 days remaining to expiration. So that's just a good time period. But more importantly, it gets us out into the summer months. And hopefully we're going to start seeing some relief from the virus, and maybe, who knows, a cure. Well, that would be, you know, the best thing that could ever happen. All right. So let's summarize the actual option trade. Here is the Ally Invest order ticket. We're buying to open one. This is, in theory, paper trade. June 19th expiration. The strike is a 93 strike call. Right now, the mid is 957. The ask is 965. So the market's moving a little bit on this trade. So right now, that would be $965 if you paid the ask. That would be your total risk. If you're thinking about buying 100 shares, we'd buy one contract. That's how we would do it on paper overall. And once again, not meant to be a recommendation. We're just trying to learn here on the stock play of the day. So with all that said, let's go back to the S&P chart, and let's do a quick little summary on the markets.
Yeah, I mean, I think that today's move downward in the markets is really just the market taking a bit of a breather after 2 really strong weeks. We're going to get earnings, like I said, and that's going to be, investors are going to be listening closely to each individual company talk about earnings for more guidance about what the future is going to look like for the economy. So that's going to be important, Brian.
All right, and normally we'd be answering your listener questions right now, but I want to highlight that at the Stockholm edition, Stock Play of the Day, we are still taking your questions. Still type them into the chat box in the right rail, and we'll be happy to answer those questions on next week's show. The option strategy, very straightforward. We're having vols coming on down a little bit, so we just went out and bought a long option contract. We limited our risk. I like that in this type of marketplace. A lot of people say 10%. oh my gosh, I still could have that much risk. But overall, now that the markets have moved the way that they have, it sounds a little bit better now to limit that risk to that 10%. So that's going to be the paper trade for this week. All right. Well, that's it for the at-home edition of the Stock Play of the Day. We'll see you same time, same place next week.
See you next week.